the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares were little changed today, even as markets and the region rose. The Straits Times Index was up a marginal 0.04% at 3,813 points at about 2:51 p.m. Singapore time, with a value turnover of some 660 million Sing dollars seen across the broader market. Now let's take you through the closing numbers. As we shared with you earlier, the STI closed in the red, down 0.17% at 3,805 points. In terms of value turnover, we are looking at 1.33 billion Sing dollars. Gainers outnumbered losers though, 259 versus 214. Top advances for today we've got for you GMH USD, New Incorporation USD and Amara. And top decliners we've got SGX, DBS and Wilmar International. Now, in terms of counters to watch, we have Amara because shares surged 27%. Shares of the hotel group surged 27% shortly after market open to hit an all-time high. And that is after the Hwa Hong, Wing Tai and Teo family consortium yesterday launched a bid to take Amara private at 89.5 Singapore cents a share. Now, elsewhere from HSBC Bank launching a 3 billion share buyback after reporting a 25% fall in first quarter profit to fast fashion giant Shein Group, hiking US prices by, get this, as much as 377% ahead of imminent tariffs on small parcels. We've got more corporate and international headlines in focus. And joining me on the line today is Too Jun Cheong, Assistant Dealing Manager from Moomoo Singapore. Jun Cheong, welcome back.
Hello, Tian Tian. Thanks for having me.
Great to have you. And Jun Cheong, let's start with the Singapore stock market. As usual, we'll talk about Amara later. But how did the STI fare today? Any surprises when it comes down to the biggest movers?
So after falling for 3 consecutive days, the STI traded positively before the trade at close session to close 4 days in a red at a 38.05 mark. So near-term wise, after the Donald Trump's liberation day, the STI is trading range-bound between the 37.90 mark to the 38.15 mark. So I guess for Singapore investors, they will be really watching for the earnings results of our 3 local banks coming next month, especially as they constitute a large proportion of our STI. So for counters to watch for me, especially in the STI, I'm personally looking at Singtel. So amidst this ongoing global uncertainty, Singtel has continued to fare really well compared to other STI stocks, with a year-to-date of over 20% gain. So during times of such volatility, defensive sector tends to do well. And so far, Singtel has held true to this defensive nature. So with the tariffs ongoing, uncertainty coming, and with the possibility of the pause that is being held now being stopped anytime, investors could also shift their focus into a lot of these defensive sectors.
And Jun Cheong, I do want to take a look at hotel group Amara because shares of Amara surged 27% shortly after the market opened to hit an all-time high. And that is, of course, after the Hwa Hong, Wing Tai and Teo family consortium yesterday launched a bid to take Amara private at 89.5 Singapore cents a share. How would you read into the move as well as investors' optimism today?
I think it's really, really good news for shareholders of Amara Holdings. Like I said, the stock surged more than 27% and then it closed at 25% at 88.5 cents. So with the closing price at 88.5 cents, it is about 1 cent away from the price that is looking to be acquired at. So for arbitrage traders, they would have to consider the risk of this acquisition risk of 1 cent or about 1.13% profit before they take on any action. SGX, on the other hand, will be having a headache as this looks likely to become another privatization event. So this will further their woes to enhance the Singapore market. And based on the investors' optimism that we see today, it is also very likely that this privatization will actually go through, especially since this is the second attempt. And investors they do keep the price of Amara near the acquisition price. For investors, they also should note that the offer price by the consortium has a premium of over 33% over Amara's net asset value as of December 2024. So this offer price allows shareholders to realize their investments and at I would rather say a rather attractive premium. For Amara Holdings, they have not raised any funds since from the equity market since their listing. So it has really become less and less beneficial for them to continue being listed as well.
I see. Well, another counter to watch for today, Jun Cheong, is SATS, because its wholly owned subsidiary Worldwide Flight Services has partnered the Port Authority of New York and New Jersey and global investment manager Realterm to open this $270 million cargo terminal at John F. Kennedy International Airport in the U.S. Now, just to set some context, this is the airport's first new cargo terminal in 3 decades, 30 years, and will help to reduce congestion and streamline operations. So back to the question, as usual, Jun Cheong, what will the move mean for SATS' balance sheet, and how far are investors' reactions today justified?
So the share price of SATS at closing fell about 3 cents to close at 1.07% lower for today. And generally speaking, I guess this is unlikely due to this $270 million cargo terminal that they'll be investing on. Rather, I see that this deal as being business as usual, which is part of the ongoing strategy by SATS senior management team when they acquired Worldwide Flight Services in 2023. Instead, I would say the share price of SATS has been affected by the ongoing global uncertainty and trade tariff war, which has really affected a lot of their upstream and downstream business. So year to date, SATS is down about 20%, really reflecting the realities of these turbulent times for SATS shareholders. The direction by senior management to expand its global footprint has certainly met its challenge, and shareholders must consider if they're able to commit with the same view with the senior management, which is to really look long-term, even as they capture even more market share when they are already the largest air cargo handler. So from a financial analysis angle, SATS, they do have sufficient liquidity, revenue is good, EBITDA is climbing, but the share price-wise, it hasn't. So this is, of course, mainly from a lot of macroeconomic factors. So again, investors do have to consider if they are able to hold on to their investments during such turbulent times together with SATS, or perhaps find better opportunities in the market.
Okay, and across the region, Jun Cheong, let's take a look at China, because Beijing's ambassador to India, Hwa Hong, said in an editorial for the Indian Express newspaper that China would not dump its goods in other countries due to its trade and tariff war with the US, and what's seen as a bit to sort of allay fears of cheap Chinese goods flooding other markets. What do you make of that, given how India recently just imposed the temporary tariff on steel imports to curb a surge in cheap shipments, particularly from China?
I think the world has become increasingly more fragmented, and they are looking more inwards, especially after U.S. President Donald Trump's reciprocal tariffs. So it's no surprise that many economies, major or minor, are looking at ways to safeguard their economies, especially when they do know that China, also known as the world's manufacturer, we have to look at other markets to sell their goods. So personally, for me, India's reaction is rather normal, because when cheap goods enter into the economy suddenly, consumers will, of course, initially be very happy things are cheap. However, the side effects of such cheap goods coming to your economy is that certain industries will feel the pain afterwards. For example, I use Indonesia, for example. There are talks to implement tariffs on incoming Chinese textile goods for them to protect the Indonesian textile industry. If too many cheap goods flood the markets, factories become obsolete, jobs are lost, and there are many other socio-economic factors and impacts that can follow afterwards. So this is just one of the examples of how a huge influx of cheap goods can affect the local economies and on a bigger scale impact the societies altogether. This is why the reaction from, let's say, India or many other leaders in the world are being justified by a lot of their citizens right now in the bid to protect the longevity of a lot of their industries.
I see. Now, if you're just tuning in, we're in conversation with Too Jun Cheong, Assistant Dealing Manager from Moomoo Singapore. While Jun Cheong further away, all eyes are on earnings out of Europe and the US. And for one thing, if we just look at earnings out of HSBC, it launched a $3 billion share buyback after reporting this 25% drop in first quarter profit today. How far were the latest numbers, along with its performance target for the near term, in line with your expectations? And again, how are investors taking in the news?
So share price for HSBC, both in Hong Kong and London, it rose 3% and 2% respectively. So year on year, the pre-tax profit, they dropped about 25%. However, analysts have expected a pre-tax profit of $7.8 billion. But HSBC did come out with overwhelming profit before taxes of US $9.5 billion, leading to a lot of optimism for investors. And this 25% headline figures has already been priced in by many analysts, as this is mainly due to the one-time charges related to their business disposal in Canada and Argentina. So I guess in the top of many minds for HSBC shareholders will be the ongoing restructuring. So all in all, the bank expects to deliver over about 1.5 billion of annual savings by 2026. And with such restructuring, this amount could certainly continue to beef up their annual reports.
I see. And in the meantime, let's talk about e-commerce and parcels and fast fashion, Jun Cheong, because fast fashion giant Shein Group hiked U.S. prices by as much as 377%, I think, for one of the categories, ahead of imminent tariffs on small parcels. What are the motivations, though, for Shein to hike prices, and what will this mean for U.S. consumers?
377% is really huge, and for U.S. consumers, definitely pricier fast fashion goods. So for U.S., with their high purchasing power, has been one of the key reasons for the growth of Shein. For consumers who are price sensitive, it has always been cheaper the better. So with the hike in price due to the tariffs, we are likely to see a dip in purchases by U.S. consumers towards Shein and possibly move towards other fast fashion giants such as H&M, Zara, or maybe Uniqlo. This will also inevitably spike up the inflation rate for U.S. consumer, furthering the U.S. Federal Reserve woes to lower the sticky inflation rate to their 2% target. For Shein, on the other hand, they are at the crossroad of this ongoing trade war. So the U.S. market is Shein's biggest market, and they cannot simply just withdraw out of this market and focus on Germany or UK, which is their next two largest market. Ultimately, they would have to continue to price their goods as competitively as possible to continue attracting U.S. consumers to all manufactured products that's more appealing to the U.S. consumer despite the higher price. So for me, Shein, which has been eyeing for an IPO, it's likely to put this plan on hold until the situation becomes more certain.
Okay, and finally, before we let you go, Jun Cheong, the Fed's preferred inflation gauge, or the PCE price index, is due later in the week. What are you expecting on this front, and what implications will this have for the Fed, as it, as always, walk the tightrope between managing inflation and ensuring maximum employment?
The U.S. Federal Reserve probably have one of the toughest jobs in the world right now. So I guess looking at the CME Fed Watch 2, it's almost certain that the U.S. Federal Reserve will keep its interest rates decision unchanged for May's meeting, implying that inflation will continue to stay stickier and interest rates will continue to be higher for longer. This is coupled with the fact that the probability of a U.S. recession is climbing higher and higher due to the trade policies implemented by U.S. President Donald Trump. It is increasingly likely that the U.S. will move into the state of stagflation, meaning prices will continue to climb while there is little to slower growth in the economy. So while the PCE is a leading indicator itself, it is unlikely for it to have already captured the effects of Mr. Donald Trump's reciprocal tariffs, and thus we are unlikely to see too huge of a swing from a month-on-month basis or even year-on-year. So nevertheless, I think investors will certainly continue to keep a close eyes on the PCE result, especially as bond and yield prices have been fluctuating fiercely for the past 2 weeks.
I see lots to watch indeed. Thanks so much for the insights as always, Jun Cheong. That was Too Jun Cheong, Assistant Dealing Manager from Moomoo Singapore. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.